Personal finance practice problem using OneNote. Mortgage rate, APR, break-even point. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab. We're in the 5163 Mortgage Rate APR Break-Even Point tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on down below. We're looking at two different mortgage type of scenarios, looking for the break-even point. In other words, here's a recap of the scenarios. Here's the two loans we're going to be considering. First one, we need $100,000. We're assuming here we're purchasing a home or something like that, and we need $100,000 for the financing of it in both of the scenarios. The first loan, we see that the closing fees are $1,000, so we're going to have fees that will be included that will be tacked on to the loan, or in other words, for issuing the loan, they're going to basically take the money up front out of basically the loan finances that we're going to have. We're going to pay it back by adding it to the loan. Therefore, we now owe $100,000 for the original home purchase, the amount that went to the purchaser or the person selling the home to us, right? And then the other $1,000 is going to be tacked on to the balance, and that goes to the processing of the loan. Then we have the interest at the 7%. It's going to be a standard 30-year loan. If we were to compare that to another loan where we have an option of the same $100,000 we need to purchase the home, but then the closing costs are now $4,000 instead of $1,000. They have higher closing costs. The fees are higher, meaning we're now going to have to pay back $104,000 on the loan, but the interest rate is lower at the 6.5% as opposed to the 7%. So you can see these are similar scenarios. Question then, is the $4,000 worth paying or adding to the loan balance up front, in essence, if we get this lower rate of the 6.5? Now, the next step usually to figure that out is to look at the APR. That would be the next step, and that will be what we'll take a look at, because the APR is an attempt to roll in the closing costs of the fees into the interest rate so that they're kind of included in the interest rate, and then we have a rate that's comparable, and then we want the lower rate when we include the APR. Now, that would be good, and that's generally going to be good if you're holding the loan for the entire loan term, in this case 30 years, because that means that this calculation is going to be allocated over, in essence, the 30-year time frame. That's kind of how it's going to be working. So we're gonna generally have a situation, our comparison is purposely going to be set up where the APR is going to be less for this one over here, meaning we have the higher closing fees, but the APR is going to be less because the interest rate is going to be less. And then you'd say, well, I picked this one. And then we have the caveat of unless you're going to be selling the home, you're not going to be holding on to it for the entire 30-year time period. Because note what really happened here is you got this $4,000 that you kind of paid up front, meaning you added it to the loan term, and you're paying it off over 30 years. And over the 30 years, it evens out to a lower APR we'll see happening. But if you're not going to be holding on to it for the entire 30 years and you sell the loan, then the amount of net gain you're going to have is going to be less if it's earlier in the loan. So the question then is, where's that break-even point? If we're talking 30 years, how long would you need to be holding on to it in order for the beneficial rate between these two loans to basically take place, given the fact that you have this upfront cost here that is a lower upfront cost that kind of evens out over 30 years? Where's the date that it basically evens out? Where's the date that the two loans would, in essence, be equal in balance? So let's see if we can get this going. We're going to say the first loan, taking on scenario 1, the loan is $100,000. The closing costs are going to be the $1,000, we'll just call them fees, the interest 7%, and the years 30. So that means that we're going to have the number of months are going to be 30 times 12, or 360 months for the term of this thing. So, and just note, just to get an idea of this, like if we were to sell it, if we were to take the home and sell it right away, let's imagine we financed the entire thing. So we needed $100,000 to buy the home. Obviously, generally you need a down payment and whatnot. But just to get an idea of it, well, let's say we financed it and then we flipped it the next day And for whatever reason, the next day we were able to sell it now for the $200,000. So that means that you'd have to pay off the loan because you financed the loan at 100,000, and then they added on that 1,000 of the charges to the loan balance. So if you hadn't paid off any of the loan and you basically financed the entire thing and then you sold it the next day for 200,000 or whatever, the net balance that you would get would be the 99,000. That's trying to emphasize, we're looking to emphasize the fact what is actually happening to that 1,000 fees that you're taking on. You're adding it to the loan costs. And you might say, well, that doesn't matter because I'm just going to be making the payments over the next 30 years. And that's true if you hold on to it for 30 years. But if you were to turn around and sell it, then those amounts, of course, are in the loan amount, and you'd have to pay off the loan at that point in time, which now includes another $1,000. So, there's a difference in what's going to happen between, again, if you're planning on holding the home for the entire time, you're using it as a home, for example, for the 30 years, versus if you expect to be selling it, sometime within that time range. Okay, so let's go down here, and we're going to say that the payment with costs. So we're going to figure out the payment. We'll figure out the APR here. So we're going to say the payment with costs is going to be our trusty payment calculation. Very useful to know how to do this calculation on your own so that you can do it basically by yourself and compare different loans so that when you talk to a loan broker or a bank or something like that, you already have an idea of what you're talking about. You don't want to completely be reliant, of course, on the person that's trying to sell you the loan to determine the calculations generally, because you'd like to be able to have a good idea of what's going into it. So doing this in Excel, quite useful. We do this problem in Excel if you want to take a look at it. So I'm going to say negative payment. Negative will flip the sign. You could put the negative in the present value factor, but I like to put it up front when I can. We're going to say the rate. The rate is going to be the 7%. That's a yearly rate. Remember that loans always have that yearly rate, so we're going to divide it by the 12 to get the monthly rate, comma, number of periods. Number of periods would be 30 times 12, or 360. We just picked up the 360 here, comma. The present value then is going to be the 100,000 plus the 1,000. So even though we only needed 100,000, they tacked on the extra 1,000. Therefore, the amount that we're going to have to pay, according to this calculation, $671.96. Then we have the APR, which you can calculate with the rate function. So we'll do a little bit of a twist of hand here to try to get the APR, which is going to be a rate that kind of rolls in that 1,000 into the rate. So it looks like this. And this is the monthly APR, and then we'll get the yearly APR. So we got the rate. It's going to be the number of periods, which is once again 30 times 12, or 360, comma, the payment. The payment then is going to be what we just calculated at the 671. So we're using that higher payment, comma, and then the present value is not going to be the 101, but we're just going to take the loan, the 100, not including the fees. That's the kind of twist that's going to allow us to get the APR that represents the higher APR that includes the fees in it. So we do this just to kind of get that one number, and then we take that and we multiply it times 12. So we took this calculation. This would be the monthly APR 0.005916 times 12, and we get about 7.10% if we round it out. And that would be the APR. The APR always being higher than the interest rate, because it includes costs, the cost of the loan. So then you can run a running balance on this. Now, I won't go into too much depth on the running balance because we've seen them in the past, but just when we do the running balance, just note that you're going to be picking up the full balance of the 101,000 here. And basically that includes the total tab over here I tacked on, which just includes the fact that we had $1,000 fees that were added that are part of the costs, and then we're making the payments off. So then when you calculate the interest, we're gonna have the payment, which we calculated up top, this payment here. The interest will be calculated using the interest rate of the 7%, not the 7.10. So that's what I just want to emphasize. We're not using the APR to make our amortization table, because that 1,000 is included basically in the balance, right? The APR is there to roll in that $1,000 into a single percent that's going to be a more comparable percent rather than comparing the dollar amount and the APR. So that's just what I want to emphasize here. If I take the 101,000 divided by or times 0.07, that would be the interest for a year divided by the 12. That would give us the 589. and then I could subtract these out. So if I'm paying 672 about minus 589 about, we've got 83 being the difference. And if I take the 101,000 minus the 83, we get about the 109.17. And I won't do that, all the way through, but it's really useful to be able to put these together. You can put them together quite simply using Excel and put together your amortization table. And so you can see all this in basically one tab. There's also online calculators. So let's take a quick look at the online calculator. So there's many online calculators, just one of them, but you can plug your information into here. We got the 100,000, we got the 30-year, 7% monthly on the compounding, every month on the payback, 1,000 added to the loan, and then that's basically it. If we run it, calculate it, we got the amount financed at the 101. We got the payment every month at the 671.96, which is what we got here, 671.96. We've got the 241.903, the total of the 360 payments, and then the total interest here and the all payments. You can also get an amortization table this way as well. So you can get a lot of information. They also have the APR of the 7.099. They took it out one more digit than we did, about 710 on the APR. So pretty useful tool on the calculator. I still like using the calculator to kind of double check what we would do in Excel, because you do have a lot more flexibility in Excel. If you do this running balance table here and copy it down, which you can do quite easily in Excel just using autofill, then you'll get down to the 0 at the bottom line number. Let's do the next one. Same kind of concept. We're going to say this is the one where we had 100,000 loan, closing cost 4,000, interest rate now not 7% but 6.5. So and again, if you were to imagine that you financed the entire home, let's say for the 100,000, you turned around and sold it for now 200,000 the next day before you paid off any of the loan, then you would think you'd have the gain. But now notice your loan balance is at 104,000. So the difference, the net that you would get is the 96,000, even though you just turned around and you financed the entire thing and you turned around and sold it, because of course that 4,000, although it's going to lead to a smaller APR, is going to increase the loan amount, so that if you were to sell the home, you would actually be better off. If you sold it obviously in day one, you'd be better off not picking up these closing fees or the higher closing fees, because you're having a higher loan balance that you're going to be paying off. However, if you take the higher loan fees and you hold on to them for 30 years and pay them off, and you're just going to hold on to then the APR is going to be the better calculation that you will generally help us as to which would be better. And then of course there's somewhere in between. What's the break-even point between those two scenarios? Between how long should I be holding, how long would I have to hold the property in order for the added costs to be worthwhile or play themselves out. So let's see, same calculations down here. We're going to say the payment with the costs. Here's our payment calculation. Payment's going to be the rate, which is going to be the 6.5 divided by 12, because that's the yearly rate. So we divide it by 12, comma, number of periods is now going to be 30 times 12, or 360, and then comma, the present value is now the 100,000 plus the 4,000, or the 104,000. Then we have the APR monthly. So now we're going to do our rate calculation. This is the APR calculation. So we're going to pick up the rate, but we're going to have that little twist so that we're not going to be picking up the full 104,000, the amount that the full amount of the loan after the costs, but just the 100. So we're going to say the payment, or the number of periods, is once again 360, comma, the payment. Remember, the payment needs to be negative or else you won't get a number here. So negative on the payment, that's going to be the 657.35. And then the present value, which if we were to put in the 104, would give us 6.5%, because we're just doing it. But we're not putting in 104. We're just going to put the 100, not including the fees. And that gives us our monthly APR, which we can then multiply times 12 to give us our yearly APR. So we took, in essence, the monthly 0.005734 times 12 to get about the 6.88%. So this was smaller than the APR, I believe, which was 7.10 than the prior loan. And of course, it's greater than the interest for this loan because it's always greater. APR is always greater than the interest rate because it takes into account the fees. So if you compared them, both of those loans, you would say that this one would be the better one to take if you were going to hold the loan for 30 years. However, the question then would be, we already saw that if I sold it after day one, that I would be worse off because I basically front-loaded these costs. That's what they did. They took the money up front, and then we're paying it back over the 30 years. So I can see that I'd be worse off if I basically sold it in day one. So the question is, well, how long would I need to hold the loan for that prepayment to wash itself out or work itself out to actually be beneficial? And that could be the break-even in time periods. So notice you could do the same kind of calculation with the amortization table. I won't do it in detail here, but you take the 104 now. That's how much we're going to be paying off. The payments are the 657, which are going to be what we calculated up top. Interest is calculated as the loan, the 104 now, times not the APR, but the rate, the 6.5, because the cost of the 4,000 is in the loan balance. And then you divide by 12, interest payment minus interest gives you the reduction in the loan. And then the 104 minus the reduction gives you your difference in the loan. Again, fairly easy to do this if you put this into Excel, and we do have that in our practice problem. You can also do the financial calculator here, 100,000 loan. This is, if you just find this on the internet, there's multiple financial calculators. I'm not advertising this one or anything, but 30 years, the 6.5% monthly APR every month, 4,000 costs that are added to the loan. Calculating that, we get a 104,000 loan, the 657.35 on the payments, right? The 657, that's what we came to, right? 657.35, and then we had the amount of the payments, and the rate is going to be the 6.881. They took it out another decimal, so that's fine. So now, if we scroll all the way down, the next question then is to do this comparison. Now, there's a couple different ways we can look at the comparison. I'm going to do it the intuitive way first, meaning I'm going to take these two amortization tables and find where the two loan balances are the same, or you can see where your total payments in essence with fees are basically the same. And then next we'll do it in a mathematical way, which might be a little bit easier to do when you're doing these types of comparisons. So first of all, we took these two amortization tables, and the only thing we did is we changed it. This is the loan balance as you go from month to month, and this is the total costs. Now, the total costs, we're starting with the costs of the finance costs, meaning this one we only needed 100,000, then they tacked on another $1,000. This one we only needed 100,000, they tacked on another $4,000. And so then as we go through, we're looking at the payments that we had. We got that 1,000 that they kind of tacked on, plus the payments of the 672. That's where we're getting this 1,672. Plus we have another payment then of the 672, and so on and so forth. Here on this side, we're doing the 4,000 here, 4,000 plus the payments, right? So we started at 4,000 costs plus the 657, and so on and so forth. And you could see if we took the difference between these, the 1,000 minus the 4,000, we can see that this loan is greater in terms of the total paid here, the total cost to us of the 3,000. And we're looking for the point where that changes. That's one way you can look at it. You can also take a difference between the loan balance throughout the time frames and see where the loan balances flip in terms of the loan, meaning this one is less than this one, and that'll flip. So if we did that all the way down, we're subtracting these two. That's what this red column is. Where it flips then is the point we're looking at. So that's the break-even type of point. So we're going to go, all right, it happens right here, right? So we're going to say, all right, so at this point, this balance was less than this balance, and then the total cost down here, this became greater than this over here. And that's when the second loan option that had the upfront $4,000 costs that have now basically played themselves out is actually working out to be better. So after this point in time, you would think that the second option would play out to be better, which you would have determined with the APR because it was lower. But if it was any time before this, then the added costs would not be beneficial, because you would sell the home and you'd have to basically eat those costs as part of the, when you paid off the loan when you sold the property. You can also see that the loan balances will basically even out here, right? So this loan balance over here, the 138,751 is less than this loan balance. And then down here, you see the 140,095. Now this loan balance is greater than this loan balance. So you can also think of it, when the two loan balances will even out. Now, how can you do that kind of mathematically? So that might be a little bit easier than lining up two amortization tables. So here's going to be the data that we have if we didn't do the amortization tables. We got the loan one, and we figured out the PMT, the APR, and the APR yearly, and we did the same for loan two. Let's do our break-even just calculation. So it could look something like this. The difference in the costs, the upfront costs were $4,000 for the more expensive upfront cost to the $1,000. That difference is $3,000 in terms of the costs. So how long would it take for those costs to play out if we look at the differences in the payments that we're making? In other words, for the first loan, we're making the payments of the 671. We've got the higher payments versus this one over here, but we're not paying off that, we don't have the higher cost. We only got $1,000 versus $4,000 of cost. So the difference in the payments, the $671.96 and the $657.53, gives us a difference of $1,460. So we have a difference in fees that we paid up front, the higher fees by $3,000 more up front, in essence, that were tacked onto the loan. And then we have the difference in the loan payments that is $1,460. So we can basically divide that out. We could say, all right, then if I take the $3,000 divided by the $1,460, we get the 205. So 205 months out. And if we take that and we divide it by 12, then we get 17.12 years. So in other words, if you were to hold on to this loan, this property, for less than 17.2 years, then you may be better off actually with the higher APR, picking the one with the higher APR, because when you sell off the loan, you're not going to have to eat as much as of the closing costs that will be there. And if you go higher than the 17 point something years, then you're at a point where the closing costs being higher up front have played themselves out versus the lower costs per month that you're paying, so that you would be more beneficial to pick up the first one. So again, bottom line scenario, you're saying APR would be the best, lower APR better, but that's a general rule if you're holding onto it for the full loan term, the 30 years. And then you'd be saying, second, the higher costs would not be worth it if I was to hold on to the higher costs, if it had if I had to sell the home right after the first day after. If I sold it the first day after, we know that those closing costs would cause us a problem. And then, well, when do they play out? What's the break-even point between paying these upfront costs and then having the lower payments? We're going to say at that 17.2 years generally. And so if we calculate this, we can also see this. This is the 205 months in our amortization table. That 205, you'll recall, is right here, 205 something that we flipped from the loan balances. So you can kind of double check this information by doing it mathematically, and then basically working out the tables and just comparing the tables and trying to see when the two loans basically even out. And it's might be worthwhile to spend some time with it because it can be confusing.